Hi there. In this video, we explain how the VAT Flat Rate Scheme works for UK small businesses, including its advantages, risks, and that it may or may not save you money.
Hello and welcome. From all of us here at My Tax Accountant, thanks so much for joining us. Okay, imagine this. You're a freelance consultant, maybe an IT contractor. You are absolutely brilliant at what you do, but let's be honest, that endless pile of receipts for your VAT return, it's draining the life out of you. You didn't start your own business to become a full-time bookkeeper, right? Well, today we are going to demystify a potential solution for that exact problem, the VAT Flat Rate Scheme. We're going to look at the pros, the cons, the real-world impact, and figure out if this HMRC shortcut is a genuine time saver or actually a hidden financial trap for your business. So here's what we're going to cover. First, we'll talk about the problem, that standard VAT headache. Then we'll look at the promise of the flat rate scheme. After that, and this is the most important bit, we'll dive deep into the limited cost trader catch. Then we'll put the schemes head-to-head with some real numbers, give you a checklist for making the right choice, and then we'll wrap it all up with a summary of what you really need to know. All right, let's kick things off with the problem that I'm sure many of you know all too well. We're talking about the sheer complexity and the admin burden that comes with standard VAT accounting here in the UK. I mean, seriously, does that question hit a little too close to home? For so many small business owners, the time you spend chasing down receipts, making sure every single purchase has a valid VAT invoice, and then calculating what you owe, it can honestly feel like a full-time job. You know, even with making tax digital, forcing everyone to keep digital records, that doesn't just magically get rid of the day-to-day chore of logging and classifying every single transaction. It's a huge distraction from what you should be doing, growing your business. So, the standard way of doing things is this constant balancing act. On one side, you charge your customers 20% VAT on your sales. That's your output tax. On the other side, you have to meticulously track every bit of VAT you've paid on your business expenses. That's your input tax. And every quarter, the amount you pay to HMRC is simply the difference between the two. Now, it's the most accurate way to do it, for sure, but wow, it demands so much attention to detail. So, what's the solution? Well, HMRC knew this was a massive headache, especially for the smallest businesses. So, way back in 2002, they introduced the flat rate scheme. Let's dig into the promise behind this supposedly simpler approach. The idea at its core is actually pretty brilliant. Instead of all that adding and subtracting of output and input tax, you just take your total sales for the quarter, including the VAT, and apply one single fixed percentage to it. Now, that percentage isn't 20%. It's a much lower rate that depends on your industry. You still charge your customers the normal 20% VAT, but what you actually pay over to HMRC is calculated with this one, much simpler sum. So, what's the appeal? Well, the benefits are pretty clear. Number one, it slashes the amount of paperwork. You don't have to worry about the VAT on every little purchase. Number two, it makes your VAT payments super predictable, which is a massive win for managing your cash flow. And because that flat rate is lower than the 20% you're charging, you get to keep the difference. For some businesses, this can be a nice little bonus. But as we're about to see, you really shouldn't count on it. But hold on, it's not a free-for-all. To get in on this, your annual turnover, that's your sales before VAT, is expected to be £150,000 or less. And you've got to keep an eye on things, because if your total income, including the VAT you charge, goes over £230,000 in any 12-month period, you're out. You have to leave the scheme and go back to standard VAT. So you have to monitor those numbers. Now here's a nice little sweetener that HMRC throws in for new businesses. For your entire first year of being VAT registered, you get a 1% discount on whatever your flat rate percentage is. So let's say your rate is 12% and your turnover is £80,000. That 1% discount saves you $800 in tax in that first year. Not bad, right? It's a nice little bonus when cash flow is usually at its tightest. Okay, and here is where we get to the absolute heart of this whole thing. For a long time, the scheme was great. But then, HMRC got worried that some businesses with really low costs were making too much out of it. So in 2017, they introduced a huge change. And this is the catch. This is the thing that can turn what looks like a great deal into a really expensive mistake, especially for modern service-based businesses like consultants and freelancers. This is the one term you absolutely have to understand: limited cost trader. You get classed as a limited cost trader if your spending on what HMRC calls relevant goods is super low. Specifically, you fall into this trap if your spending on these goods is less than 2% of your gross turnover, or if it's less than $1,000 a year. It's a two-part test, and figuring out what actually counts as relevant goods is the whole game.
And if you are deemed a limited cost trader, well, the consequences are massive. You don't get to use your nice, low, industry-specific rate anymore. Nope. Instead, HMRC slaps you with a mandatory, much higher rate of 16.5%. Now think about it. When you charge 20% VAT, the equivalent on your gross turnover is 16.67%. So a rate of 16.5% completely wipes out pretty much any financial benefit of being on the scheme. It just makes it way more expensive.
And this table just perfectly shows you the trap. The definition of relevant goods is incredibly strict. It basically means physical things you use up in your business. So yeah, for a shop, their stock counts. For a plumber, their tools count. But look at the list of what doesn't count. Software, IT services, your accountant's fee, phone bills, marketing, rent. For most freelancers and consultants, these are their biggest costs. And none of them count as goods. They're all services.
And make no mistake, this wasn't some minor tweak. It was huge, and it was intentional. The government's own numbers said this change was designed to bring in an extra $130 million a year in tax. And while they said it was about tackling abuse, it ended up catching thousands of honest, small businesses, IT contractors, writers, consultants, you name it. The very people the scheme was supposed to help in the first place.
So, knowing about this massive catch, how on earth do you decide what to do? It's not a simple choice anymore, it's a financial calculation. So let's move on and actually put these two schemes side by side. This table really nails the trade-off. With the flat rate scheme, you get simplicity, but you give up reclaiming VAT on almost all of your expenses. The only tiny exception is for a single capital purchase over $2,000. With the standard scheme, yeah, there's more admin, but you get to subtract all the VAT you've paid out. The right choice completely depends on what's more valuable to you, saving time or saving money by reclaiming that VAT. Okay, let's make this real. Let's run the numbers. Say we've got an IT consultant with a gross turnover of £90,000. That's £75,000 in sales plus £15,000 in VAT, and they've paid out £5,000 in VAT on their costs. Right, under the standard scheme, their bill is £15,000 minus the $5,000 they reclaim, so they pay £10,000. Easy. Now on the flat rate scheme, let's say their industry rate is 14.5%. Their bill is now £13,050. But as an IT consultant, they're almost certainly a limited cost trader, so their bill rockets to 16.5% of £90,000, which is £14,850. That's nearly $5,000 more in tax just for picking the simpler option.
Ouch.
So how do you apply this to your own business and make sure you don't fall into that expensive trap? Well, you need a clear process. So here are the steps you have to take. This is your game plan. Step 1, check you're even eligible based on your turnover. Step 2, and this is the big one, do the limited cost trader test on your own spending. Be brutally honest about what really counts as goods. Step 3, run the numbers for both schemes, just like we did in that example, but with your own figures. And step 4, and this is so important, this is not a one-and-done decision. You have to recheck your LCT status for every single VAT period, because if your spending changes, you could accidentally get pushed into that higher rate. And here's a vital tip from us professionals. Getting that limited cost trader calculation wrong is not something HMRC messes around with. If they look at your books and find you've used the wrong rate, they will come after you for all the underpaid tax, plus interest. And on top of that, they can hit you with penalties for being careless. So being accurate here is everything. All right, let's bring it all home. We'll wrap up with the most important points to remember, and then we'll talk about how you can get some expert help for your specific situation. So, if you remember anything from this, remember this. The promise of simplicity is really tempting, but it can be a very expensive illusion. That limited cost trader rule has totally changed the game, and it makes the scheme a bad deal for a huge number of modern, service-based businesses. The only way to know for sure what's right for you is to crunch your own numbers and keep reviewing that decision as your business grows and changes. And that really is the final question, isn't it? As we look ahead with all these complexities, with this huge trap waiting for so many businesses, is this scheme really the right choice for you? There is no easy one-size-fits-all answer, which is exactly why getting professional, tailored advice is so important before you jump in. Look, we know this stuff is complicated. At My Tax Accountant, we can help you run those numbers, figure out your LCT status for sure, and help you make the best choice for your business. Don't leave it to guesswork. Give us a call or drop us an email for a consultation. And of course, don't forget to subscribe to our channel for more helpful guides just like this one.
And finally, just the usual bit of housekeeping. Please remember, this explainer is for general guidance only. It is not a substitute for proper professional tax advice. Tax rules can and do change, so it's really important you speak with a qualified professional about your own situation. Thanks for watching.